Hello, and we are live. Welcome to your market update. My name is Vinnie, my co-host over here.
David Wright, thank you once again to our millions of followers, especially someone important out there. I want to give a shout out. Gentleman's name, Shaw, not you. You're not that important, Vinny. Give a shout out to one of our, people that enjoy watching us. Just want to say thank you. Appreciate the support and just giving some gratitude out there.
All right, so we got a smorgasbord of stuff, and we're gonna pack this into 10 minutes. All right, smorgasbord. Like s'more, like just like smorgasbord of a s'more.
Wow.
All right, I'm gonna start it off with, if you can get one guess.
I keep waiting for Disney to contact us and sue us for that intro, but that's not important.
Wow. All right. In what community did the most expensive attached home sell for in 2021? So far this year, San Diego County, and a little hint, it sold for more than $6 million. Attached. Expensive attached home. Okay.
Attached home.
Attached. All right.
I'm gonna have to say, I know this isn't your house, Vinny, because yours sold for $10 million, but I mean, are we going to be in the downtown area for this, or Del Mar, maybe, or UTC La Jolla? The penthouse is at the top above the mall. Absolutely gorgeous.
Well, we'll bring that up in a second. Let's get into the quick numbers. So we got good news and we got bad news today. All right. So the not so good news, I'll say not so good news compared to the bad news. Not so good news. We have 2,800 active properties in San Diego County. We were at a little over 3,000, about 3,100 roughly about like a couple weeks ago. Mind you, we were at 2,000 a couple months ago. But if you watched us on Monday, you've seen that we're slowly getting less and less inventory on a weekly basis. Pending hasn't really dropped too much compared to where it was last week. So something to kind of think about. One area that was kind of interesting, active detached properties, 700,000 and under, actually went up a tick. So even though across the board we had inventory go down a little bit, active detached under 700,000 went up a tick. So that was kind of interesting. Now, I did say there's positive and negative. So the positive, the median home price across the board has trickled down a little bit as of last month. Okay, so mind you, what's happening right now with the inventory, that's going to be playing out during this month. But last month in August, the median home price has gone down. Detached median home price has gone down also. So we were stagnant the last 2 months, or June, July. Now it's actually trickled down a tad bit. And median list to sold has dropped pretty good. We're under now 102 compared to where we were just a little while ago when we were talking about 103, a little under 104 median. Now, if we go to average, that's a little bit higher, but median is where we're looking. So positives and maybe not so positive. So we'll see what happens over the next couple of weeks. Hopefully we get a little bit of an uptick of more inventory so these trends can kind of play out and make it a little bit easier for potential buyers out there. How are rates looking?
Are you ready? Since you went with the positive and the negative, we're going to start out with just a bunch of data just to jump into this so it makes sense. And it's not going to be like I was going to say, what was the band that did Jump Around? Was that Cypress Hill?
Yeah, I don't remember that band. I know the band, but I don't remember.
Anyways.
I can't even sing it.
Well, anyways. So we had a lot of important data come out this week. And for a lot of you out there know that where the data goes is where things follow. So when you start looking at the data today, we were supposed to have job creations come out, and we're supposed to have 700,000. We had 235. That's a massive amount of jobs not created as opposed to what was expected. So that was not good. Then on Wednesday, you had ADP come out. ADP was expecting 500,000 more jobs to come out. We only got 374. So all the jobs report about the economy rebounding back have not been positive. They've been extremely negative. Everything's been massively missed. Now, the weird thing is jobless claims, which the people who are applying for unemployment benefits and COVID type pandemic relief, that's actually going down. So that's good. That means people are going back to work. The reason why I'm bringing all this back together is if the economy is not recovering as fast as they say it is, the job creation is not there, the new jobs are not being created, and ADP is not funding more payrolls, that means we don't have that many people working. So what does that say to the Fed? It says to the Fed, we better stay dovish for a little bit longer, because if they come back right now and they step in and they start raising rates right away, you will already take an economy that's not recovering and you will basically deem it to basically a slow death like a dinosaur in the tar pit. Not a good analogy, but that's reality. That's what could happen. And with that being said, it's very like vivid. What's that?
Very vivid.
Yes, very vivid. So no one wants to be a dinosaur in a tar pit. And with that being said, the bond market hasn't been good this week. Mortgage-backed securities haven't been good this week, which means rates, basically they were lower on Monday and Tuesday, and they've kind of butterflied around through the rest of the week, not like butterfly like Muhammad Ali, but more like stinging like a bee, to where they weren't as good as they were before. But historically still, what are you looking at? I mean, your rates are still below the threes, still amazing. Your jumbo paper is back down 2.75, 2.875 jumbo.
What's owner occupied?
Owner occupied, depending on what you're looking at. If you're looking at conforming loan amounts, which, you know, is above your 548, those have dipped down. They've been in 2.6 range, 2.75, which is smokingly amazing.
As what's investor?
No point loan. Now your investor stuff, a lot of your investor stuff has been varying depending on if it's a duplex, triplex, 4 units, condo, SFR. You have a lot of factors at play. For those of you out there, when you call a lender and you ask them what their rate is and they don't ask you any questions, they're basically giving you a BS answer. Because if you don't know the property type, the loan amount, the FICO score, you're going to have problems getting the correct interest rate. So take that into consideration. Just to answer your question, Vinny, your non-owner stuff, it's been varying. It's been between 3.5 to 3.875. And, you know, multi-units have been smoking good deal lately. You've been at almost like 3.6, 3.75, no point loans on multi-units. Like as an investor, you got to look at that and go, where else can you buy that money that cheap for? Almost nowhere. And sorry, I've been on a. No.
I love it. And hopefully the people love it. Man, I saw your question. I'll bring that up in a second. I want to get back to the original question. We've got a minute and a half left. In what community the most expensive attached home sell for in 2021? San Diego County. Read the clicker on the bottom. Chance to win $50 if you pick the right community. All right, let's get to Manuel's question real fast.
You know, I thought what I thought I would mention to some of you out there is if you're investing in the home right now, you're basically investing into yourself, because you cannot buy debt so cheap as you can right now with interest rates and then get the rate of return on your money. If you're buying money at, let's just take worst case 3.5%, but your house goes up 5% per year, which we've been well above that, you are absolutely creating wealth at a quickly compounding rate that you cannot do anywhere else.
I think I just saw another post that on social media today. But all right, let's go. From the chart, it seems like this shows when the prices go dip, it goes back up quickly. All right, let's see what he's going at. Let's get that slide back. I think he's talking about the median. Yeah, so this is for the last 3 years. This is before. I think this was before. Let me take his question off. All right. So yeah, let's see. We're talking about January. So this is basically the holidays kind of dips down a little before like December timeframe. This calls kind of went down a little bit before we were, and then COVID. I think COVID was right about here, so it came down a little bit and then went back. Right, COVID was last March, right? 2020.
Oh, we're more than a year now.
Yeah, it was last March, right? So I think this was about when COVID, and right, that little dip right there after 2020, is when it kind of dipped down because that was COVID, and then it kind of jumped back up. And you see me in that kind of jump. So we haven't really seen, because it looks like a bigger drop that we've currently have compared to where we sat. But you got to see the jump in everything. Okay, now we're past 10 minutes. But yeah, hopefully I answered your question, Manuel. On some of the dips, it's more been holiday based, and the other ones have been basically, I guess, the COVID stuff at the beginning of everything happening. So, anyways, hopefully I answer your question. Guys, have a great one. Thank you for watching. If you have any questions, reach out to myself or David. Have a great one. Bye, everyone.
Thank you.